I want to welcome on today's guest, Mish Schneider. Mish is the chief strategist at MarketGauge, normally coming to us from Santa Fe, New Mexico, but today we have the pleasure of welcoming you live to our studio. Mish, it is so good to see you again.
Oh, it's such a pleasure to be here. Thank you so much for having me.
The last time we saw you here was for ChartCon 2022 at the last year, which was a ton of fun. A lot's happened, I feel like, in the world and in the market since we last sat down together in person. Fed Day today, a lot of different narratives. Talk us through how you're sort of interpreting what we heard and where we should be focused.
Well, everything that he said was pretty much expected. So there's that. And of course, there was the reaction because I think the market was hoping for a little bit more passivity in terms of what he was going to say. And he said, we may pause, or at least we're near the end. And this was not language the market wanted to hear. So I'd like to step back a little bit from that because you mentioned a couple of things before the show. Number one is you mentioned the fact that we are in this incredibly persistent trading range.
Sure.
And of course, it depends where you look, but if we're looking generally at the three major indices, that's certainly the case. And none of them have been able to really clear the 23-month moving average, which we've looked at before.
That's right, yep.
And that represents expansion beyond a two-year business cycle. Clearly, we're not seeing that. But also, conversely, we're seeing that the Russell 2000, which is way weaker than the other three indices, hasn't broken down under a 6 to 8 year moving average, which we see through the 80-month. So that's going to be the real question. But looking at the bonds for a second, I wanted to really show two different types of bonds because in terms of history, generally yields start falling after May, number one. And in terms of forward yield analysis, both of these are very undervalued. So one would be high corporate grade bonds. And, and obviously that represents some of the bigger companies, the companies that have the better balance sheets. And that's actually holding up pretty well, even though compared to that forward yield analysis, it's down 7% in terms of how undervalued it is.
Okay.
So as bad as the picture looks, and as much of the conversation has been about the banks and how horrible that whole thing is, right now, if it turns out to be undervalued and seasonally accurate, we could actually see those go higher. That would be a positive. And then on the opposite side of the fence, of course, is the high yield junk bonds. And those are the companies that don't have good balance sheets, but yet bond traders buy them because they pay a very high yield. And those two have tested the 50-day moving average. They are over 11% undervalued compared to forward yield analysis. So if both of those things hold up, or one of them do and the other one goes sideways, it would be hard to make the case for a major recession or for things like the SPY breaking down under its 3,800 support, or if it does not for very long.
It's really, really interesting. I mean, so when we're talking about the major averages like the S&P, the NASDAQ, all facing resistance, right, and sort of being unable to break above, the S&P kind of 41 to 4,200, NASDAQ composite as well. You're seeing the same kind of pattern with high yield debt. How important is it for the HYG and J and K, right, those high yield bond ETFs, to break above that resistance? Should we be thinking of it similar way that we would think about with the equity indexes?
I would definitely think of it that way. And Fed funds rate now at 5.25% are where they were in 2006. And if the seasonality does make sense and we start to see any kind of relaxation of the yields from here, and by the way, the 10-year notes are also slightly undervalued compared to where they are historically. So if we start to see anything happen in the yields where they move lower and these two areas of bonds in particular move up outside of the range, I would say that that's probably a good harbinger of perhaps, I'm not saying a sustained rally, but at least not the collapse that people are fearing.
Another chart that you sent was looking at retail, granny retail, I believe we call it, right? And when you're looking at the XRT, we have a daily chart on the left side, a weekly chart on the right side. When you're looking at the retail space, is this an area of the market where you see opportunity or where you see cause for concern, or both?
Well, it's also in a persistent trading range. So the reason why I brought in Granny is because we already know, you've talked about regional banks before I came on, right? And the importance. Well, regional banks have always been part of the family, the prodigal son. And it's amazing how they've taken center stage, obviously, right now. And so I think it's important to note that if this really is the great unraveling based on what's happening with the banking and more of the rural areas, we have to look at the consumer as well. And the same kind of thing, so underperforming what we're seeing, let's say, in growth stocks or in the S&P 500, but yet holding on for dear life to that recessionary line in the sand at around 56 and 60 being pivotal, which it closed above today. So I think just like we were looking at regional banks coming into March, we have to be looking into retail coming into the end of May. The whole sell in May, is it going to be true? It's lots going to be concerning on what happens here with Granny.
It's so interesting how the XRT sort of testing the lower end of the range, but you think of, certainly some components, certainly in this, but like footwear names that come to mind, these just nice, strong, like Skechers and others over these nice, strong trends. How do you think of it in this sort of environment where there's that challenge between the benchmarks that are sort of choppy sideways, a retail ETF that's sort of down at the lower end, but then areas of retail are actually very, very strong? How are investors supposed to get their head around or place the appropriate bets in that sort of environment?
Well, that's a great question, because the reason why we've chosen XRT to represent the consumer is that it has a broad exposure to staples, discretionary, e-commerce, and also brick and mortar.
Right.
So you've got a good feeling there of what's going on. And yes, I think maybe one of the reasons why she hasn't fallen apart, if I can give her a gender here as grandma, is because of some of the strength pockets that we've seen in some of the staples, like a Walmart or some of the foot.
Sure.
But what's so interesting to me from a consumer instinct standpoint is we just came from Las Vegas, and it's packed, and people are spending money.
Right.
Walking around even here in Redmond, people are out and about. And so there's either a great disconnect of the reality of what the consumers are doing out there and what we're seeing here. And again, I won't get really negative unless we start to see all of the areas, including some of the consumer staples, start to unravel.
People may be walking around Redmond because it's not raining finally, but that's beside the point. Your point is well taken. You're right. It's pretty odd. We were just in New York last week for the CMT symposium. Same thing. I mean, it was jammed with people. I mean, I didn't see any issues with people spending money. They were out there and spending aggressively. Can we talk about precious metals? You and I have spoken a number of times about gold, about silver. It's been one of the stronger areas of the market for sure. But now we're sort of in this condition where gold is facing, all-time highs, $2,000 an ounce. What do you see with the setup of gold now and looking forward, given all the uncertainty that we see in the markets?
Well, if I may, when I was here in October, ChartCon, that was one of my picks. So I
remember that vividly.
Yes,
it's well said. Yes, agreed. Noted.
And it's not even a matter of being right, but it was really a matter of seeing exactly what gold is doing right now, which is being the ultimate hedge against pretty much all the fear that's out there, and there's quite a list. Yeah. And so looking at gold right now, we had predicted that maybe 2,600 would be a good target, give or take $100. But nonetheless, what gold is really showing right now, and silver, which is interesting because there's the relationship between silver and gold, is that there is a lot of concern in the world, whether the concern be more crises coming from the banks, whether it be geopolitics, whether it be the debt ceiling, although I'm not as concerned about that, whether it be inflation, even though people are starting to say deflation. There's always a possibility that inflation picks up. Core inflation, PCE, is still high, globally high. So I think all these reasons are going to continue to support the gold market. It's hard to chase strength typically, but these dips, which I thought was actually hoping would be a little bit deeper, down to around 1950, didn't happen. Now here we are close to 2050, and if we can get to 2050, you're looking at GLD right there. Then I would say, there's certainly more money to be made. Back in the day, people thought, overbought. But commodities are not PE ratios. They are emotional plays, and people want to pile in. Same thing with silver. Also, around $25.50 right now an ounce. The SLV, it was up around 27 in that COVID. It became a meme stock for a minute. Yeah. But now it's showing some real value here. And so to me, look here, it's very hard for me to be convinced that we're heading into deflation.
We only have about 30 seconds left, but I'd love to just ask you briefly about crude oil, because crude oil, of course, dropping significantly this week. Energy stocks, we mentioned in our market recap, continuing to lead the way lower. Is there hope for energy? What would you look for to find an opportunity when crude oil continues to go lower?
Well, Well, it's interesting because not only obviously is that really the one place to look at where you can make the case for some kind of a recession coming, and this is where people are looking to say deflation. But there's also been a lot of bad press for energy and oil on the basis of the fact that a lot of places are mandating that things be switched to alternative energy.
Sure.
And it's kind of like AI. This could be running a little bit ahead of the actual reality of what that really means by 2025, 2026, or 2035 for that matter. And of course, there could be snags, which would be copper, which we need for EVs and alternative energy. So I would say if we get down much further from here, it'll probably start to look a little bit more tempting. But we have not really looked at the energy space or think that it's the end-all be-all for inflation.
Mish, this has been awesome. I feel like we could spend a couple hours here chatting. We have to keep it at this. Thank you so much for coming in town. It's so good to see you, and have a safe trip home, okay?
Thank you so much, David.
It's Mish Schneider. Mish is the chief strategist at Market Gauge from Santa Fe, New Mexico, joining us here in the studio.